Good morning, doctor. My name is Deebanthini. ANNATHURAI metric number is 2788779. Now I am going to present about the determination of financial risk management of Ajinomoto's food and beverage company in Malaysia. In this research, I found the issues that identifying the internal and external factors that influencing quick ratio of the Ajinomoto's company. Next is problem statement is the factors that affecting the quick ratio of the company over the period of 2018 until 2022. Now we will see the research objective of the research. First one is to pinpoint the internal variables influencing the quick ratio of the Ajinomoto's company. Second is to pinpoint the external variables influence the quick ratio of the Ajinomoto's company. The third one is to pinpoint the internal and external variables that influencing the quick ratio of the Ajinomoto's company. The next one is research question. For this assignment, I found that the first one is there a connection between the internal variables and the quick ratio of the Ajinomoto's company? Then the second one is there a connection between the external variables and the quick ratio of the Ajinomoto's company? And the last one is there a connection between internal and external variables that quick ratio of Ajinomoto's company influencing? For the literature review part, I take quick ratio as a dependent variable for this Ajinomoto's company. So the quick ratio indicates whether a company has enough readily available cash to cover the immediate liabilities. A high quick ratio suggests a liquidity, that the ability to pay a current liabilities on time, while a low ratio indicates a weaker liquidity of the company. So that the companies with a high quick ratio are often seen as attractive for investment, but potentially attracting more capital and positively impacting a market performance. So in this literature review part, I've explained about the internal variables and external variables too. For the internal variables, the first one is return of asset. Return of asset means a profitability metric used to assess how effectively the business generates its profits from its business. A higher ROA indicates improved asset management leading to increased net income and high investor interest. So in this case, Ajinomoto's trend keep decrease for all years for the ROA because the assets of the companies keep increasing without the net profits increase. The second variable is return on equity, which is ROE, is a measure of an organization's ability to generate profits its owners. So consistent and steady increase in ROE suggests the company is a proficient at enhancing shareholder value through strategic reinvestment of earnings to improve productivity and profitability. Moreover, for make sure this statement, I found that Chen and Weiss 2009, the study said that Chinese listed company found an adverse association between ROE and liquidity risk. Its reduced liquidity risk was linked to better profitability as measured by ROE. The second is debt to income. It means a lender use DTI to estimate how much a person can safely borrow. Different lenders may varying standards for DTI when determining the mortgage loan eligibility. DTI of no more than 36% is typically sought by the lenders. Okay, now we will see the external variables of the Ajinomoto's company. The first one is gross domestic product, which is GDP. GDP is a measure of economic activity to quantify the total yearly of value all newly created final goods and services within a country's border. A more true understanding of economic activity is achieved when population and inflation are taken into a consideration in the study. For example, in this case, I take 2021 year, which is the lowest GDP, which is 3.1. This is because the price of the raw material and the fuel continues to rise unabated for that year. This makes the GDP is lowest for the year. So the second variable is inflation. Inflation is a steady increase in the average price level of goods and services in an economy over time. So the reason is behind inflation are complex and often interconnected with a different economy theories providing distinct viewpoints on the underlying mechanism. For make these statements more accurate, I found that studies by Calder 1938 suggest that the supply side variables contribute to inflation are such as rising production costs, increased input prices, or monopolistic practices. So this is the statement for the inflation. Okay, for the methodology part, I used data sampling and variable selection. Data sampling is a study that involves a food and beverage company in Malaysia, which is the Ajinomoto's, and its annual reports and the Malaysia's macroeconomic data worth for 5 years, which is 2018 until 2022. The second one is a variable selection. For that, the dependent variable, as I said earlier, is I choose quick ratio, and the independent variables are 3 model, which is the first one is model 1, impact of the internal factors on quick ratio. Second one is impact on the external factors on quick ratio. Model 3 is impact of both firm internal and external factors on the quick ratio. Okay, the next part will be the finding and analysis part. For that, the first one is about the descriptive statistics of the internal and external variables. In the descriptive statistics, I found that the mean and standard deviation of the dependent variable, which is quick ratio, is 5.1537 and 3.2696. The result of standard deviation of a quick ratio proof a very small marginal variation occur in 2018 until 2022. The second is the average collection period, which is ACPE, is 20 as an average mean of 20% as an average mean of 60.2537 and a standard deviation of 21.8483, which shows the ACP for the over 5 years is highest one in mean and standard deviation. The higher number of accounts receivable in relation to total sales revenue is the reason for the ACP is keep increasing for the 5 years. ROA, second one is ROA as the mean and standard deviation of 0.0823 and 0.0385. Average of ROA of the food industry from Malaysia had faced 8.23% of net income from the year 2018 until 2022. This is because the standard deviation is low, which is 0.0385, and the variance over the last 5 years are relatively minor and constant net income is guaranteed. Okay, now we will see the correlation part. For the correlation, the strong correlation with the quick ratio is namely with ROA, ROE, current ratio, operating margin and interest rate are reflecting a strong positive correlation, which is 0.086, 0.827, 0.999 and 0.730 and also 0.714 respectively. For the DTI, inflation, exchange rate shows that negative strong correlation with the quick ratio, which is negative 0.783, negative 0.886 and also negative 0.812. The last one is moderate correlation with the quick ratio ACP, which is 0.384, operation ratio, which is 0.505 and also GDP, which is 0.408. These three variables shows that not significant towards the quick ratio. The second part is model summary. For the model summary, model 1 shows that adjusted R square, which is 0.998, is the variation in the quick ratio is not significant and accounted by the three variables, which are operation ratio, current ratio and ACP. For the model 2, the adjusted R square is the 0.796, which is not significant to the quick ratio and accounted by the interest rate, GDP and inflation. Model 3 shows that adjusted R square is 0.791, which is not significant towards quick ratio and accounted by the exchange rate, ACP and also interest rate. Next is ANNATHURAI part. For the ANNATHURAI part, the first model 1 ANNATHURAI shows that reflects the overall regression model that is significant, which is 0.027. Model 2 ANNATHURAI shows that the overall regression model is not significant too, which is 0.285. And the last one is model 3 ANNATHURAI shows that reflects the overall regression model that is not significant too, which is 0.289. So for the two model shows that not significant and model 1 shows that significant towards the variable, which is quick ratio. The second part is coefficient. For the coefficient, exchange rate variable, which is 14.190, shows that exhibits a negative association with the quick ratio variable. And second one is ACP, which is average collection period, is 0.036, and the interest rate, which is 2.533, exhibits a positive relationship towards the quick ratio variable. Last but not least, we will see the conclusion and recommendation part. For the conclusion, ROA, ROE, current ratio and operating margin and ACP reflecting a strong positive correlation with the quick ratio variable, which is the dependent variable. So to make this statement more strong, according to the study by the team C, which is 2023, investors and creditors use liquidity measures to assess a company's ability to pay a short-term debt and to what extent. The second point is Ajinomoto's business used the quick ratio to evaluate a company's financial strength and sustainability for investment. Lastly, the quick ratio of the Ajinomoto's food and beverage industry is mainly influenced by the internal factors, which are the ACP, return on equity and return on asset, operating margin and current ratio. That's all from me. Thank you.